What is working capital? Current assets minus current liability is called working capital. For day-to-day operation, we require the cash. So cash plays very important role in the business. Speculative motive, there is some speculation goes, share values goes on increase or decreases. Lessor is the owner, lessee is the utilizer of the trade. You can utilize for 2 years, 3 years, whatever may be, you have to pay the rent for that. Hello, my dear student. It's a warm welcome to revision of financial management 2. I divide the entire syllabus into 2 groups, Part A and Part B. I'm going to do a touch of the revision classes for those chapters which already I have explained in the other classes. The last sessions are considered in YouTube. I go to very detailedly about this financial management. Now, and as a revision, now I will take the subject and say that how to work out, which are the important points to be noted here. Regarding the BCom 6th semester BCom financial management, the question will be asked like this. First question, determination of what are the factors which determine the working capital. What is the first point? What are the factors which determine the working capital? Major theory. For that, a substantial notes we are going to give you. Then a problem on working capital, very simple problem on working capital, 15 marks. Then you go with the cash management. You are going to get one problem called cash budgets are considered. Then we have got credit policy number 3. Next, you go to the leasing is considered. Once you go to the leasing, then we have got economic order quantity. Then you have got ABC analysis. We have got inventory management. So these are the portion to be covered here one by one. So today I am going to discuss about the 3 problems which are got. One on, we have got working capital, one is called cash management, another is called the leasing is considered. So we'll go one by one slowly with the examples. So introduction and the key concepts. So the entire goes, one is working capital management, one is cash management, working capital financing, that is leasing, venture capital financing, shareholder value creation, and international financial management. So we'll go one by one. So the pattern of the question paper, 4 into 520, 3 into 1030, 2 into 15. So we'll ask 6 questions. You have to answer any 4 questions, each carrying the 5 marks. Then the part B will ask the 5 questions. You have to answer any 3 questions, each carrying the 10 marks. Part C will go with the 3 questions, 4 questions. You have to answer any 2 questions, each carrying the 15 marks. This is the pattern of the question paper. We are going to set as per the UAM, University of MYSURU. So we'll go with the first unit. Working capital management. What is working capital? Current assets minus current liability is called working capital. So what is working capital? Current assets minus current liability is called the working capital. Which are the current assets? Are cash in hand, stock, work in progress or material in process, finished goods, debtor, prepaid expenses. Which are the current liabilities? Are creditor for purchases, lag in payment of wages, lag in payment of overhead, any other outstanding expenses that should be deducted. Current asset minus current liability, that's called total working capital. And contingencies may be 10% or 15%. Add to that figure, the total is called net working capital. So we'll go through the problem. So this is the cost sheet they have given. Material cost 40 rupees. Labor cost 15 rupees, overhead cost 30 rupees, total cost become 18.5 rupees. If you add the profit 15 rupees, it become 100 rupees selling price. While you're doing the working capital, don't take the profit into consideration. This should not be considered. Profit should not be considered while doing. So while valuing the finished stock, while valuing the debtor, you must value at the cost price only. The value of the debtor, the value of the finished stock should be valued only at cost price only. That should be remembered. So we'll read on. Then he says, raw materials are held in stock an average of 1 month. materials in process an average of half a month. This is very, very important. While you are doing a material in process, you have to take material 100%, labor 50%, overhead 50%. I will repeat, material 100%, labor 50%, overhead 50%. So finished goods are in stock an average of 1 month. Credit allowed by supplier means creditor. Credit allowed to customer is called debtor. This you have to remember. Credit allowed by supplier is creditor. Credit allowed to customer is called debtor. Lag in payment of wages means outstanding. Lag in payment of overhead means outstanding. 1/4 of the sales are made on cash basis. So cash transaction should not be considered here. Then cash in hand is expected to be 50,000. Expected level of production is 52 units for a year of 52 weeks. Means all should be converted to week. In a year, we have to taken 52 weeks, not 48 weeks. You have to take 52 weeks. Calculation will be made on weekly basis. So you convert all into week basis. So first we'll go production is equal to 52,000 units minus cash sale. Here no cash basis. See that 1/4 of these sales are made on cash basis. So totally you got 52,000 units are there. So production is 52,000. Even the sales are 52,000. 1/4 of the sales are made on cash basis. Cash sales 1/4. So 4 ones are 4, 4 threes are 39,000 becomes the credit sale. This becomes the debtor. So we'll go one by one. Raw material held in stock an average of 1 month, he says. Raw material held an average 1 month. Come back. Here, raw materials in stock, average of 1 month. Working capital, particulars, rupees, raw materials, so raw materials, 52,000 divided by 52, it will held for how many months? 1 month means 4 weeks. 4 weeks. Into cost is 40 rupees. So 52,000 divided by 52, 1 month means 4 weeks at a cost of 40 rupees. So 52,000 divided by 52 into 4 into 40, 1,60,000. This is the raw material. What next they say is, number 2, what the next they say? This over material in process an average of half a month. Material in process half a month means 2 weeks. You say, small a, material 100%, 52,000 divided by 52, half a month means 2 weeks into 40. This is 80,000 now. 52,000 divided by 52 into 2 into 40, 80,000. B, labor 50%, 52,000 divided by 52. How many months? 2 months. What's the labor cost? Labor cost is 15 into half, 50% of that. So 52,000 divided by 52 into 2 into 15 into 0.5. So 15,000. I repeat, 2 cancel. 52,000. 51s are 15,000. Then C, overhead 50%. 52,000 divided by 52 into 2 weeks. What's the overhead expenditure? 30 rupees into half. So 30,000 add. So 80,000 plus 15,000 plus 30,000, 1,25,000. So what next you got? So this over. Finished stock 3. Finished stock 1 month. So 52,000 divided by 52. 1 month means 4 weeks into cost price. What's your cost price? Cost price is, total cost is 85. So 52,000, you can write it here, 1,60,000. This become 1,25,000. 52,000 divided by 52 into 4 into 85. 3,40,000. Then number 4, 52,000 divided by 52 into 4 into 5. So 3,40,000. So this is over. Credit allowed to customer. Debtor. Credit allowed. So debtor is 39,000 divided by 12 into how many months? Credit allowed to customers 2 months, 8 weeks into cost price 85. Debtor for 39,000 divided by 52 into 8. 2 months means 1 month is 4 weeks, 2 months will be into 85. So 39,000 divided by 52 into 8 into 85. 39,000 divided by 52 into 8 into 85. 5,10,000. 5,10,000. Number 5. What's your cash in hand? 50,000. Cash in hand 50,000. Add the figure. So 50,000, 5,10,000 plus 50,000 plus 3,40,000, 34. 3,40,000 plus 1,25,000 followed by 30 plus 1,60,000 followed by 30, 11,85,000. Total current assets 11,85,000. Then we'll move on. Particulars, rupees, current minus current liabilities, first one, credit allowed by supplier is 1 month, creditor for materials 1 month. So this is 52,000 divided by 52. 1 month means 4 weeks into 40 rupees. Same thing what you have done. 52,000 into 4. So that is 1 lakh. 1,60,000. 1,60,000 current liabilities. I'll go to the back side. That's all. Current liabilities. Then we have got time lag of wages is 2 weeks. Time number 2. Time lag of wages. Time lag of wages 2 weeks. 52,000 divided by 52 into 2 weeks. What's the cost price of wages? 15 rupees. So 52,000 divided by 52 into 2 into 15, 30,000. Number 3, time lag of overhead. So time lag of overhead 52,000 divided by 52 into 4 into 30. 52,000 divided by 52 into 4 into 30. 1,20,000. Add 1,20,000 plus 30,000 plus 1,60,000, 160 followed by 30, 3,10,000. Deduct 11,85,000 minus 3,310 followed by 30, 8,75,000. Total working capital add contingencies nil. Once again it becomes 8,75,000 net working capital. I will explain. Raw materials 4 months 52,000 divided 52 into 4 it is 1,60,000. Material process we have to take 100% of material, 50% it will work out 1,25,000. Finished stock is for 1 month at the cost price 52,000 divided 4 into 85 is 3,40,000. Debtor is a credit sale 39,000 divided 52 into 8 into 85 is 5,10,000. Your cash in hand is 50,000. Total current assets work out 11,85,000. Then minus current liabilities. Your current asset is 11,85,000. Creditor for materials 1,60,000. Time lag of wages 30,000. Time lag of overhead is 1 month means 4 weeks is 1 lakh. 3,10,000. If we deduct, it is 8,75,000. There is no contingency at all. If there is any contingency, it's 10% on this only you have to calculate. There is no contingency at all. So the net working capital becomes 8,75,000. This is the way you have to fill them down. Now, we'll move on to cash management now. This is another important chapter which we are going to be covered. One is called cash management. Cash management is also called treasury management, or we can say management. So cash is the lifeblood of the business. Cash plays very, very important role for the management is considered. So the lifeblood of the business is the cash. It is the process that involves collecting and managing the cash inflows from its operating, investing, and financing. So cash budget, we are going to prepare cash management, how much cash inflows, how much cash outflows you are going to calculate. In business, it is a key aspect of an organization's financial stability. The stability of the business depends upon the cash availability, how much cash inflow, how much cash outflow you are going to calculate. Cash management is important, both companies and individuals. This is very, very important. It is important for individual also. It is important for the company also. It is a key component of any financial stability. If the company wants to have the financial stability, there must be very flow of the fund. Flow of the fund, we say, inflows and outflows is regularly we have got. How much cash available at the end of the year we have to calculate. Financial instruments, I know as the cash management contain money market fund, treasury bill, and certain certificate of deposit we have got. So these are the method of your collecting the cash management is considered. Then motive of holding cash, one is called transaction motive, require the cash to meet to day-to-day needs of the business, called the transaction motive. For example, on a day-to-day basis, the business is required to pay off for the purchases, salary we require, wages to pay, taxes to pay, interest to pay, dividend pay. So the transaction motive is nothing but is called motives of holding cash. So first motive is transaction motive. For day-to-day operation, we require the cash. We have to purchase the material. You have to pay the salary. We have to pay the wages. We have to pay the taxes. We have to pay the interest. We have to pay the dividend. For a day-to-day transaction, we involve the transaction motive. In order to meet the cash needs for this, no issue. A business is required to hold sufficient amount, because no sufficient amount should be held by the company in order to pay the dividend, in order to pay the taxes of the company, in order to pay the wages, in order to pay the salary. So sufficient should be. So some of the time of the receipt, what's the cash in hand, cash payment, some amount to be maintained. A business may raise cash through overhead drafts. Sometimes when you are not in a position, you have to take the loan from the bank, which is considered as overdraft. So transaction motive is nothing but to meet the day-to-day operation. It may be purchase, in order to pay the wages, in order to pay the salary, in order to pay the printing and stationery formality. Printing and stationeries are considered, in order to pay the taxes, in order to pay the dividend. For day-to-day operation, we require the cash. So cash plays very, very important role in a business. So I'm doing this motive of why you hold the cash, precaution, the transaction motive we say. So in order to meet this transaction, you must have a certain idea, certain funds to be kept in mind in order to pay the dividend of the shareholder, in order to pay the tax of the government, which are the essential factor. That's a point to be bear in mind. Then precautionary motive, a business is expected to various uncertainty and contingency. They may happen without giving any signal. Therefore, a business required to cash to meet the contingency. There are uncertain circumstances. So company has to keep sufficient cash. There are unknown losses has been raised. In order to meet the unknown losses, you must have a balance of cash. So that is called the precautionary motive. In order to have a precaution, I will give an example. Especially for official, we'll open an account called, we have got three types of account. One is called SP account, one is called the current account, one is called the RD account is there. Generally, SP account has to be maintained for the official, because Once you get the salary, some amount will be kept aside in SP account in order to say that there are unforeseen circumstances, something happens. So in order to meet these circumstances, you must have a cash. So some balance should, if I'm getting a salary of 40,000, I'll keep aside about 5,000, remaining 35,000. I'm going to utilize for the business is considered how much I kept here, 5,000, to meet the unknown losses, whatever the losses. We don't know what will happen. Because the question of a life, we don't know what will happen. Some accident will happen, some unforeseen is happen. Suddenly the vehicle will be in trouble. We have to meet those expenditure. That's called, we have to keep some amount for this purpose of meeting contingencies known as precautionary motive. Then we know to speculative motive. Holding up cash in the form of reserve obtained the benefit of some specific nature, favor of market condition is called speculative motive. There is some speculation goes, share values goes on increase or decrease. Some funds has to be maintained. In order to maintain, to meet, you purchase a share of rupees 100. Today the value of the share is only 90. You are a sufferer of capital loss to the extent of 10 rupees. In order to meet these 10 rupees, you must have a sufficient fund in your company. Speculative means, for example, the business forecast that in the near future price of raw material will fall below, then it will preserve some cash to take the advantage of reduced raw material. This point is very, very important point here. So we came to know that because raw material is the part of the production, the raw material is going to be reduced, the cost of the raw material will be reduced. So when we reduce, we have to purchase the more raw material. In order to purchase the more raw material, what we require is the finance. So finance plays a very, very important role here. Here, without finance, there is no life at all, especially for business is considered. The blood of the business is move on with the help of the finance. So without finance, there is no business at all. So what they will learn is because it's a speculative motive, if the raw material has come down, better to purchase more raw material. In order to purchase the more raw material, what we require is the finance. If you are not in a good plan, you must have such a plan you have to make it such a way that, so that if these circumstances come, you must be in a position to purchase the raw material, unless you will be declared as a fool. You are not a no planning material. You do not have the no plan at all. You must have a certain plan in your life, especially for business is considered here the motive. If the interest rate of the security is expected to rise, suddenly the inspector rate is expected to rise, then the business may reserve some cash amount to purchase such security. Suddenly the security value will be raised. So purchase the security so that we'll get the more interest. Here, in order to purchase the raw material, we require the cash payment. The other way, when the securities are rises, we'll get the more interest. Purchase the security. In order to purchase security, what we require is the finance. So finance is such a beautiful way it is going to be happen. So you must have a certain plan in your life. Have a plan in the business. Keep some amount for sake of raw material. Keep some amount for sake of security. Keep some amount for sake of the unforeseen circumstances. So that this is a place. That's why you say cash management or cash budget or cash plays very, very important role. If you go with a cash flow statement, if I'm not solving the problem, I will explain the problem in such a way that, so we already solved so many problems in the YouTube. You go through that YouTube, the answer is there. If you still feel difficult, you can ask me a question. So what is it? This is the format we have got. We start with the opening balance. This is the closing balance of the last year. Next year it becomes the opening balance. Add cash inflow. First cash sale, then collection from debtor. These are all the inflows are. One is called cash sale. The balance collection from the debtor. When you make the credit sale, they are going to pay after 1 month, after 2 months. There is collection from debtor. Interest, if you have invested, there is an interest on investment you got. Issue the share, sale of the asset. Those are all the cash inflows. Then this will go, inflows is coming in. Then cash outflows are you paid to creditors, payment in future dates, tax paid, dividend paid, wages paid, overhead paid, manufacturing expenses paid. These are all the cash expenses we are going to pay. Then once from the cash inflow, deduct the cash outflow, then whatever you got the closing balance A minus B. So that become the opening balance for the next year. This become the opening balance. Next, once again, cash inflow, cash outflow, the closing balance become the opening balance, cash inflow, cash outflow, that become the opening balance for the next plan. So you have got cash sale also, you have got collection from debtor also, you have got interest on investment also, you have got issue of shares also, we have got sale of assets also. These are all called inflows are considered. The outflows are we paid to creditor, payment for future dates, no, some whatever we paid here, no, it may be you have to pay, no, you have to pay the wages, we have to pay the dividend tax paid, dividend paid, wages paid, overhead expenses paid, manufacturing expense paid. So it is called total outflow. A minus B, closing balance will come. The closing balance of the April becomes the opening balance for the May. The closing balance of May becomes the opening balance for the June. It goes same way for a long, long time. So once you understand, now we'll go to the next one. Unit number 3, working capital financing. Under this method, you are going to study in what called leasing is considered. A lease is a contract under which one party, the lessor, the owner of the asset, gives another party, the lessee. This is important. One is called the lessor, another is called the lessee is considered. Right to use the asset usually for a specific time in return for the payment of rent. So, lessor is the owner, lessee is the utilizer of that right. You can utilize for 2 years, 3 years, whatever maybe, you have to pay the rent for that. Then, leasing is a process by which a firm can obtain the use of a certain fixed asset like land, building, machinery, furniture, which must be make a series of contractual, periodic, tax deduction payment. So you have to say that it may be 2 years contract, it may be 3 years contract. So it is there. So there are 2 types of leasing we say. One is called operating lease, one is called financial lease. Operating lease is for 1 year. So once you have an agreement between the lessor and the lessee cannot cancel the operating lease. He has to wait for 1 year to get back the money. In the financial lease, the lease may go to 2 years, lease may go to 3 years, lease may go to 4 years. By chance, if the lessee is not in the position to pay the rent, he may what's called discontinue, and he can what's called cancel the contract and get back their money. That won't be possible in the financial lease are considered. So financial lease will go to 4 years, 5 years, sometimes 10 years are considered, whereas operating lease is operate only for 1 year is considered. So in the leasing facilities, no, we got 2 parties. One is called the lessor, and is called the lessee. Lessor is the owner of the particular asset. Lessee is the utilizer of that particular asset. So the contract between the lessor and the lessee we call as leasing is considered. Then how to do the problem? How to work out the problem? What is the first? When you say a word called lease, L-E-A-S-E means 5 words are there. 5 points to be remembered here. First, you have to calculate the depreciation. It may be straight line method, or it may be diminishing balance method. It may be straight method, or it may be diminishing balance method. Under straight line method, depreciation remain constant. The formula is cost minus scrap divided by life. What is the formula? Cost minus scrap divided by life is the straight line method. Under another method of depreciation, we have got diminishing balance method. So if the diminishing balance method is assumed that first year is 1 lakh, 15% is 15,000, balance is 85,000. Next year on 85,000 we have to calculate. Assumption here, 1 year, the cost is 1 lakh. So 15% of this is 15,000. Balance is 85,000. Second year, on 85,000, you have to calculate depreciation 85 into 15 divided by 100, 12,750 minus 72,250. It goes on. So this goes in favor of diminishing balance method. What's your opening value? 1 lakh. So 15,000 balance is 85,000 second year, 85,000 on this 12,000 balance is 70. It go. This is the first method. In order to calculate the problem, first method is the depreciation. Second method is cash outflow. How to calculate outflow? Year, loan amount, interest you have got, repayment of principal, loan amount, interest, deduct the interest. What's the principal from the principal? What's the first one? Your loan amount, interest is 15%. Your A is here. What's the loan amount you have to write? Interest you have to write. So payment, what's the difference is the principal money will come out of loan amount from principal money difference is cash outflow. So whatever the cash inflow, which includes the interest, no? First loan amount, interest, no? So out of the installment, deduct the interest, balance is the repayment of principal money, remaining is the cash outflow will come. So what's the installment money minus interest is principal. From the loan amount, deduct that balance you have to pay. Then third is cash inflow. What's the number 3 is cash year. Whatever the depreciation you calculated, then add the interest, make the total. On that, it may be 30% tax or 40% tax. That's your cash inflow. So cash inflow is a income. First, calculate the depreciation, then calculate the interest, make the total. On that, you apply the percentage. That is your cash inflow. Fourth one, under purchase option. Here, calculation flow under the purchase option. What is your cash outflow is there, you have to write. First, cash outflow, how much you have to pay for installment. Cash inflow means here, whatever you get, net cash inflow, PV factor, they will give according to percentage, they will give the PV factor, net cash inflow will come. This is the method. Then, so under leasing option, first you write the yearly rent, tax, net cash flow multiplied by the discount factor. Whichever is less, that should be taken into consideration. So, which are the 5 points to be remembered? One is the depreciation. One is the cash outflow. Number 3 is net cash out. First is the depreciation. You remember? First is the depreciation. Second is the cash outflow, loan amount, interest, repayment of principal, balance is outflow. That's why you have got installment money. On the first, you calculate the interest on the outstanding loan amount. For that, whatever every month you are going to pay, assume that every year you are going to pay 2 lakh, 3 lakh, 2 lakh plus interest, 2 lakh plus interest you have to go. Or by chance, if the installment includes the interest, out of the installment, deduct the interest, remaining the principal money out of the loan amount, that principal money should be deducted. I will go through very slowly. You have got a loan amount. One side. Then you have got an installment which includes the interest. Calculate the interest on the loan. Out of the installment, deduct the interest balance is the principal money. Out of the loan amount, principal money should be deducted. Balance is the outflow we have got. So whatever the principal money you have got, your loan amount, assume that whatever may be loan amount. Here, I will give an example. Your loan amount is 10 lakh. Installment, you are paying 1,20,000. Interest at 10%. Assume that what's the loan amount you have to write? 10 lakh. Interest 10% of 10 lakh is 1 lakh. So here 1,20,000, 10% of 10 lakh is 1 lakh. Assume that it is 12, every installment you have to pay. So you have got 10 lakh rupees, no? Every installment you have to pay here, no? So here every installment you have to pay 2,50,000. So I'll show you. What's your loan amount you have to write here? 10 lakh. Then what's your installment? 2,50,000. Interest is 15% of 10 lakh, 15% means 1,50,000. So 2,50,000, 1 lakh interest come. Only amount left over is 1 lakh. You have principal money, your amount is 10 lakh, but it was really principal 1 lakh. How much still has to pay? Another 9 lakh. Only principal money you have to deduct now. Here, loan amount you have to write, interest you have to write, repayment of principal money you have to write. Here, see that 10 lakh is there, 10% is 1 lakh. You have to pay 2,50,000. 1 lakh gone means what is the principal money you are going to pay? 1,50,000. What's your loan amount? 10 lakh minus 1,50,000. Balance is 8,50,000. That's important. If it is includes, by chance the problem says, they say like this. Every year you pay the 2 lakh plus interest, 2 lakh plus interest. Then how to write now? Repayment you write 2 lakh plus interest. Every year 10% of 10 lakh is 1 lakh. 2 lakh plus 1 lakh, you are going to pay 3 lakh. So out of 10 lakh, 3 lakh payment balance is 7 lakh. So it will go like this, depends upon the problem. So includes the interest, deduct the interest, plus interest, add the interest. If the problem says includes the interest, deduct the interest, add the interest, you can add the interest, that's all. Depends upon the problem. This is the first step, this is the second step. Third place, calculation of cash inflow. What are they coming in? Inflows are, first you calculate the depreciation, then calculate the interest, it becomes the total. On that, whatever the percentage of tax bracket is given, you calculate the 30%, that is your inflow. First is outflow, then blame. Next step, so under purchase option here, your cash outflow, first you have calculated, this is cash. Cash inflow is there, deduct there, the balance is net cash inflow multiplied by discount factor, that's the net cash flows. Once you have this now, then we'll go to the under leasing option, cash outflow, whatever the rent you have to pay, tax and net cash outflow multiplied discount PV factor will come here. Then whatever the amount you have got, one has a under leasing option, one has got a purchase option, whichever is less, that is acceptable. Whichever is less, that is acceptable. Hope you understand. So we already solved so many problems in the YouTube. Just an outside circle, just a bird view I'm giving how to calculate lease means for LEASC 5 points. First you have to calculate depreciation, then you have to calculate cash outflow, then you have to calculate net cash inflows, then you have to calculate net cash outflow, then you have to go with the rental value and leasing option. Whichever is less, that should be selected. Then after that, working capital fine, ABC analysis. You divide entire article into 3 groups, ABC. What is ABC? Always better control. We have got A, we have got B, we have got C. So 70% in value, A, 20% in value, 10% in value. 70% in value, 20% in value, 10% in value. So highest in value. So materials are considered. You can say that 10% in quantity. Here about 30% in quantity. But 60% in quantity. Here, more value, less quantity, modern value, modern quantity, less value, high quantity. So what is ABC? Always better control. The alphabet ABC stands for 3 different classes and it is popularly known as always better control. So ABCL is a basic analytic management tool. It divides the entire material into 3 groups. One is called A, one is called B, one is called C. So 70% in value, 10% in quantity, 20% in value, 30% in quantity, 10% in value, 60% in quantity. Then we'll go to inventory management. Economic order, we say inventory management. Now how to manage inventory means stock to be, what's called how to be stock to be stored in the warehouse. It is called economic order quantity 2AO divided by C. What is A? Annual consumption. O is ordering cost. C is called carrying cost. If you know the formula, we can apply. What is economic order quantity? 2AO divided by C, annual consumption. Then B is ordering quantity, 2AO. This is O. O is called ordering quantity. C is called carrying cost. Then we have got different stock levels are there that has to be maintained. This formula you have to remember that all. First one is reorder level, maximum consumption multiplied by maximum reorder period. What is the formula? Maximum consumption multiplied by maximum reorder period, minimum stock level, reorder level minus normal consumption minus normal reorder period. Normal reorder period means if the order period is 4 to 6, you add 4 to 6, we say 4 plus 6 is 10, divided by 2 is 5, you have to take. That's called normal reorder period. So, what's that? Minimum stock level, reorder level. The answer of the first one, reorder level minus normal consumption multiplied by normal reorder period. What is the first one? Maximum consumption multiplied by maximum reorder period. Then, third back to maximum stock level, reordering level plus reordering quantity minus minimum consumption multiplied by minimum reorder period. What is the formula? Reorder level plus reorder quantity minus minimum consumption multiplied by minimum reorder period. Last one, average stock level, maximum stock level plus minimum stock level divided by 2. You get the answer of this. Answer of this divided by 2 is your average stock level. What is the first one? Reorder level is equal to maximum consumption multiplied by maximum reorder period, minimum stock level, reorder level minus normal consumption multiplied by normal reorder period. So what's here? Reorder level is normal consumption multiplied by normal reorder period. Maximum stock level is reorder level plus reorder quantity minus minimum consumption multiplied by minimum reorder period. So come back to average stock level, maximum stock level plus minimum stock level. So you already solved the problem about this. Just go through the YouTube. All the problems are available. Just I'm giving only hint for this. Revisions are considered. All the problems already solved. So just a hint of this will be given. So we covered today. One working capital we covered. One cash management is covered. One leasing is covered. One ABC analysis is covered. And different stock levels are considered. Hope you understand. In the next class, we'll go with the detail of one problem of credit policy we are going to do. And we have got a theory of the venture capital, theory of the shareholder value creation. Then we have got a foreign international financial market or international financial money is considered, trade is considered. I'm going to explain in the next session. So hope go through whatever we solved in the YouTube. Please go through in detail. All things have been solved in the YouTube. Just a touch here I have done as a revision. Just a touch I have done. Whatever the difficult problem is there, once again we'll do it in the what's called offline classes. Still you have a doubt, you can ask me a question. We'll do it some more problems in the YouTube also. But we have solved all types of problems in the YouTube. Today I'm just a touch of the subject. Just a bird view I have given how to do, what method you have to do. Everything I have given in the revision classes. I have explained in detail. You go with the detailed classes here. Here, regarding the cash budget is considered, we start with the opening balance. Here, opening balance you have got, add cash inflows, cash sale, collection from debtor, interest on investment, issue of share, and sale of asset. That's a total cash inflow. Then you pay the outflows are paid to creditor, payment in future date, tax paid, dividend paid, wages paid, cash outflow will come. The closing balance of this become the opening balance for this. So before that, there's one word I showed you regarding the motives of holding cash. This is most important motive, transaction motive, because no, we have to keep the some cash for sake of purchase, for sake of wages, for such purchase of salary, purchase of dividend, what's called the payment of dividend you require. That's called the transaction motive. This is considered. Then precautionary motive. Sometimes you have to hold the cash in order to precaution ourselves. There may be unforeseen circumstances to meet. In order to meet, we have got some cash to be maintained. That's called precautionary motive. Then speculative motive. Suddenly, if the raw material has been come down, you must be in a position to purchase the raw material. Favorable market condition. Then if the interest rate such security is expected to rise in the business, no, you purchase a security, suddenly the interest rate will go up, will get the more profit. That is your speculative motive. Then you have got a cash budget I have explained. Then regarding the lease, we have got a two-party. One is called the lessor and is called the lessee. Lessor is the owner of the property. Lessee is the utilizer of the contract. And whatever the contract we have got between the lessor and the lessee, we call as the leasing. There are two types of lease. One is called the operating lease and is called the financial lease. Operating lease will work out only for 1 year. So the contract cannot be cancelled out till the end of the 1 year. You got a financial year, financial contract, financial leasing. It may be 2 years, 3 years, 4 years, or 5 years are there. But this leasing may be cancelled out at any time. After 1 year, any time you can cancel it out. So then we have got how to make what is the first step to do in the lease now? First you have how to do the problem. First you have to calculate the depreciation. Once you calculate depreciation, calculate the cash outflows. Once you calculate the cash outflows, then go to the cash inflows. Then you go under purchase option, you have to go. Here out of the installment money, you deduct the interest. The remaining is the net cash flows you are going to do. Then you have got under leasing option, cash flow, the rental value is there. Cash in hand, 30% has been paid. Net cash flows remaining there. Then you got ABC analysis, always better control, which have been divided in 3 groups. Part A, Part B, Part C, more in value, moderate in value, less in value, less in quantity, moderate quantity, more in quantity. Here, no, always better control, inventory management. So it is nothing but stock control here, formula 2AO divided by C. What is A? Annual consumption. O is called ordering cost. C is called the carrying cost. Regarding the different stock levels are considered, we have got a 4 stock level, reorder level, minimum level, maximum level, average stock level. What is reorder level? Maximum consumption multiplied by maximum reorder period, minimum stock level. Reorder level minus normal consumption multiplied by normal reorder period. This is very important. Maximum consumption multiplied by maximum reorder period. So minimum stock level, reorder level minus normal consumption multiplied by normal reorder period, maximum stock level, reorder level plus reorder quantity minus minimum consumption multiplied by minimum reorder period. This is important. Reorder level plus reorder quantity minus minimum consumption multiplied by minimum reorder period. Then average stock level, maximum level plus minimum level divided by 2. So for these already solved the problems in YouTube. We have gone very detailed in the YouTube. Please go through the YouTube. Everything is in the YouTube is there. Please go through the YouTube. YouTube is definitely help you. And also I have solved about the modern question paper, which covers all the chapters are considered. It is just a bird view I am doing, just a revision now. Just touch the subject and find out what are the things inside the. So in the next session, we'll have some more one on. You have got another chapter called venture capital is there. Then we have got one credit policy is there. Then we have got shareholder value creation is there. Then we have got international finance is there that we deal in the next session. Till then, goodbye. Meet in the next session.